What is going on, people? Welcome back to another finance focused news update. In this video, we're going to cover 3 stories. We're going to go through 4 or 5 of the main takeaways, and we're going to try and do that in less than 5 or so minutes. If you want to check out the articles, they'll be linked in the video description below. But with that, let's get straight into it. The first story we're going to talk about is how Goldman Sachs is exploring a unique way to grow its private bank. The second story is all about artificial intelligence and how it's moved from the back office into the front office. And the third and final story we're going to touch on today is about the feminization of wealth management. So with that, let's get straight into the first story. Goldman Sachs wants to incentivize its traders and bankers to send potential clients to its wealth management business in exchange for a referral fee based on successful client referrals. Kind of like the referral fee that you get for successfully referring a friend to a role at the company that you work at. This all makes sense given the traders and bankers will have existing clients who could also use the services of the broader Goldman Sachs offering, in this case the Goldman Sachs wealth management business. Here are 4 key takeaways from the article. First one is the fixed formula for bonuses. So unlike the current discretionary bonus system, Goldman Sachs is developing a plan to use a set formula to calculate bonuses for these referrals. This proposal is quite controversial as some employees believe additional incentives shouldn't be necessary for collaboration between different divisions. Next, we've got the 1GS program. So CEO David Solomon's 1GS program seeks to enhance collaboration across Goldman's traditionally siloed business units. The goal is to improve client relationships and streamline operations by clarifying bonus calculations for collaborative efforts. Right now, the firm, like all global investment banks, has multiple divisions and business units operating as individual entities. There are definitely benefits of 1GS, but achieving so is a lot easier said than done. Next, we've got comparisons with UBS. So UBS has considered a similar referral incentive structure, but ultimately decided against it, citing complexity and the belief that investment bankers did not need additional incentives or bonuses. This highlights the challenges and differing opinions within the industry regarding referral incentives. Last but not least, the focus on the ultra high net worth clients. So Goldman has shifted its wealth management focus to ultra high net worth clients, requiring a minimum of $10 million to open a private bank account. This strategy is part of the CEO's broader effort to build a more stable, less volatile business model by increasing assets under supervision, which currently stand at approximately $2.85 trillion. The next story is all about AI, artificial intelligence, moving from the back office to the front office of investment firms. Asset managers are increasingly using generative artificial intelligence to guide financial choices. As such, the AI arms war in asset management is shifting from compliance and marketing, typically back office functions, towards helping advisors make smarter decisions in revenue generating roles. Here are 5 key takeaways from the article. So the first point, AI integration in asset management. Asset managers are increasingly incorporating artificial intelligence to enhance investment decisions, monitor portfolio manager habits, and identify lucrative opportunities. AI is transitioning from compliance and marketing tasks to directly aiding investment professionals. Second key takeaway from the article is JP Morgan's Moneyball tool. So JP Morgan plans to expand its generative AI tool, Moneyball, later this year. This tool helps portfolio managers by flagging questionable decisions, correcting biases, and improving decision-making processes. It leverages decades of data from JP Morgan's Spectrum portfolio management platform. Third point worth mentioning is Voya Investment Management's virtual analyst. So Voya Investment Management has implemented a virtual analyst to monitor stocks for potential risks. This AI complements human analysts by providing feedback and red flags on securities. The AI's decisions have been proven to be high-value signals, enhancing the decision-making process. So Legalist uses an AI tool called Truffle Sniffer to find promising investment opportunities in litigation finance. This tool scans court records to identify cases with favorable outcomes, such as those with favorable judges or strong pre-trial rulings. Despite the advancements, some remain skeptical about AI's potential to drive long-term returns in asset management. Critics argue that most AI focus on short-term gains rather than accurately predicting long-term earnings potential, which remains a complex task. And the last article we're covering today is the feminization of wealth management. So Sally L. Krawcheck is the former head of Bank of America's Wealth and Investment Management Division, and she's currently the CEO and co-founder of Ellevest, a digital financial advisor for women launched in 2016. She's been called the most powerful woman on Wall Street and argues that given the industry is mostly run by men, the passing of this boomer generation, i.e. when these lot die, will see a transfer of wealth in the tens of trillions of dollars changing hands. Here are the 5 key takeaways from this article. The current state of wealth management. The wealth management industry is perceived as healthy and stable, delivering predictable earnings that are attractive to Wall Street, unlike the more volatile and capital-intensive trading and investment banking sectors. Trading and investment banking tend to have fluctuating revenues and profits. Asset management, wealth management tends to be a bit more steady and stable. Next, we've got the growth and demographic challenges. So much of the industry's growth has been driven by capital market performance rather than organic growth, with 70% of asset growth between 2012 and 2021 attributed to market appreciation. Additionally, the industry faces demographic challenges, with the aging workforce and a lack of diversity. Then you've got the upcoming wealth transfer. So a significant shift of wealth ownership is anticipated as the aging baby boomer generation passes away, resulting in tens of trillions of dollars changing hands. This wealth transfer will initially benefit women given their greater longevity. Point 4, there's a need for strategic shifts. So wealth management firms must adapt their strategies to better engage with female clients who often feel overlooked and disconnected from their financial advisors. Women seek more financial planning, goal-based investing, and alignment with environmental, social, and governance policies. And last but not least, the potential societal impact. So successfully addressing these shifts can lead to broader societal benefits, as women with wealth tend to be more philanthropic, invest more in their families and communities, and support moderate political candidates and climate change initiatives. The industry must recognize and prepare for this inflection point to avoid significant repercussions. Those are the 3 articles, 5 key takeaways each, in less than or around 5 minutes. Hope you enjoyed it. If you want to read more on the articles, they'll be linked in the video description below, and I'll see you tomorrow for another video and another finance focus news update. Peace.